I would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with The Rebel Broker. My name's Robert Whitelaw, and I am The Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Today is Monday, July 11th, 2016. Thank you for making this show a part of your daily routine. And welcome to a new week. I hope everyone's got their goals all set and ready to go for the week. And I hope you're using that tool that we talked about, the Google Calendar tool, where you can input a goal and tell it the time ranges and different days that you want to be able to do it. And then if you create new appointments that conflict with it, it just moves it to the next open space that works for you. So it's like a moving target in terms of being able to keep you on target for your goals. So I'm repeating that one. I know for a lot of folks who've been listening for a while, you've heard me talk about it before. I get no money from referencing it or suggesting it. It's just been great for me. You define what days of the week you're willing to do it, what time stretches you're willing to do it. And then when it's open, it just alerts you. Hey, you don't have anything on your schedule right now. Do you want to do it now? You can put it off for later or whatever. But it just keeps tapping you on the shoulder to remind you of the things you know you should be doing anyway. So go check that out. It's definitely worth your time. A little bit of housekeeping to do today. We've actually got a really interesting report that is a just huge pile of data. So we're going to weed through it a little bit, and it's aimed directly between the eyes of anybody who's interested in real estate, whether you're an investor or someone who's just trying to track what's going on with values in different areas. And we're going to be able to look at this data in a couple of different interesting ways. So stay tuned for that. A few things I absolutely wanted to bring everyone up to date on, though. First, as I mentioned, I think last show or the show before, you can now obtain the show via YouTube. As part of the automatic publishing process, YouTube will get an upload from me of the show. So at around the same time, in between 1 and 2 a.m. on the Monday through Friday days of the week, just as the audio show is published, it'll get published on YouTube as well. Now, my plan is also to publish the promised investment tool that I use, how to analyze properties. I'm going to go ahead and do that one that way and see if we can't make that work for everybody. I know I've had a few people who've asked when that's going to get done. I found the tool I'm going to use to create it. I need to kind of sit down and figure out the logistics of getting it all done. So that's coming as well. I also wanted to let everyone know that the show is now available on Spreaker. That's SPREAKER.com. So if you're consuming the show if you're consuming other things through Spreaker, or you've kind of been having to go out of your way to get to my show, Spreaker is now a new way to get a hold of it. I verified that it's up and running and working correctly as of Friday. So take yourself over there if that's what you're interested in, and you'll be able to consume it there as well. And in addition to Spreaker, I am pushing to be able to be available on iHeartRadio. So we will see what happens with that. I submitted the show to iHeartRadio on Friday as well. And as soon as I know what's going on with that, I will get back to you. I just wanted to give you the heads up in case iHeartRadio is one of the ways you prefer to consume your content. Finally, I do have one huge favor to ask. Now, I realize I ask all of you every show to go out and rate the show on iTunes and whatever other tools you use to consume the show. Today, I've got a different focus, and this one is a big favor to the show. As you probably know, I'm definitely in growth mode with the show, and what I need to do now is get the demographics of my audience. So that is an audience survey that is currently available, where you log in and you answer a few questions. It basically just reveals the kind of person you are, and it helps create a profile for the folks who listen to the show. You can find a link to it on the front page of www.therebelbroker.com. There'll be a big red button at the tippy top of the page above the menus and everything else. Take a survey to support the show. If you would mind going and filling that thing out and submitting it, I would be forever in your debt, as I seem to always be, for you even going to the trouble of consuming this thing. But it would absolutely help the show. As you know, I'm moving towards a model where I'm going to potentially allow sponsors. And in order for sponsors really to be able to evaluate whether or not it makes sense for them, it's good for them to know the makeup of the audience that listens to the show, instead of just relying on me telling them the kind of folks that might be listening to the show. This way we get the data directly from you. So if you could take a minute out of your day to go fill that out. I've checked it out. It's 5 or 6 questions. It's really not that big of a deal, but it will be a big help in me being able to show the world the kind of folks that are listening to the show. So if you could take a minute out of your day, head on over to www.therebelbroker.com, click the big red button at the top, and you can go participate in the survey. I will also be including it in the show notes of every show that I publish until enough folks have filled out the survey. I think the number they're looking for is 200. So given the number of folks who consume the show on a daily basis, that shouldn't be too difficult to reach, depending on how enthusiastically everyone runs over there and fills out the survey. But if you could take a minute, fill that out, that'd be a big help for the show. So let's go ahead and jump in. The data that we're going to be talking about is coming to us from All Property Management, and it's their 2015 ranking report. This actually just came out, but it gives us some very interesting data based on they look at the top 75 U.S. metro areas in 2015, plus a little bit of a preview of where they think 2016 is heating up. Some topics we've already talked about here. Excuse me. But I wanted to sort of hit some of the high points. There's some interesting data, and we'll get into that, because remember, one of the things that I like to look at are some of the more obscure numbers. Unfortunately, most numbers that get reported today really love the big numbers. So they like to talk about, $1 million plus homes as an average price in San Francisco, and talk about that as being an amazing place to go, and that's a robust market. Well, see, for most investors, a great capitalization rate is what folks are after, right? You want a higher return on your investment. So, and return on an investment is also in a lot of ways going to be higher, but it's only if you measure it in terms of the dollars, right? So you would absolutely expect the return on investment on a $1.2 million house in dollar terms to be higher. But what you want is the percentage, if you're really focusing on the lucrative investment opportunity. Why? Because if you have a higher capitalization rate in a city where properties are a lot cheaper, well, instead of having one $1.2 million property, go ahead and get yourself 5 $200,000 properties, and there you go, right? You're actually working with a higher capitalization rate, and you're making more money, and you've got a more diversified portfolio of residential properties, so that if you go vacant for a period of time, you're not making $0 for some period of time, right? So that's why I like to focus a little bit more on cap rate. So that's one of the numbers we're going to go ahead and actually talk about today relating to this. A few little tidbits I got from the article that kind of jumped out at me. Right now, home ownership is the lowest that it's been since 1967. And just right off the bat, that's a number that interests me, primarily because when you see a trend in a number that goes that low, you can count on a time coming when that isn't going to be the case anymore. I think the argument can be made right now that the most likely scenario in the not the super near term, because we're just not seeing the construction necessary to make this happen, but it makes sense that we're going to start seeing more properties coming online to satisfy this demand. And there's no question that we'll see that pendulum swing the other way. But because of the obstacles that are sort of in the way of development, and since so many of these things tend to solve higher-end purchasing needs at the beginning, it'll be a relatively slow swing, but eventually that marketplace is going to turn. So for me as an investor, what I'm thinking in those terms, and particularly since I'd want to compare this to the area I'm in, right? Now, despite the fact we can say nationally that home ownership is at its lowest since 1967, you're going to want to find out the truth in your city or your area where you are. Is that the truth? Are most folks renting in your community, or is it the lowest number of occupied by owner stats for your city right now. Find out where you fit in terms of the rest of the nation. But in general, if we're talking about trends across the country, this is what we're seeing. And once you've kind of digested what that number is, me as an investor, what that equals to me is I need more buffer. I need to be able to adjust appropriately given a change like that. Because if suddenly it changes and more people want to go ahead and own, well, that tends to represent a reduction in renters. So that's likely to affect someone like me who might own a property in that marketplace. So given that, might want my cap rate to be higher. I might want to be able to be a little bit more nimble in how much I charge for my rental property if market values drop. If rental values drop, I'm going to want to be able to compete and continue having folks renting my property, making me some amount of money that still is above my expenses, right? So this is something to keep in mind as a purchasing thought. Or if you already own, it's a warning flag. It's something to think, I've looked at my market. I see that this is something that's probably going to happen. The one upside to this is it's not going to happen over a weekend. Right? This is going to be a trend that starts to make a move over a period of time. And you'll see it because more homes will come on the market. Prices will tend to go down, assuming that we're building enough inventory to satisfy demand at least an equal level, right? For the rental folks, though, for those of you who are holding a rental, I would even consider that warning that's relatively early. Because I think the first strip of this will tend to be homes that are at the slightly higher end of the marketplace, at least where I live, and it may be different where you are. But because of the rules and regulations in place and because of the way things work here, you tend to see homes built that are slightly above what the average is in terms of price. Now, those homes, assuming an adjust in the marketplace, or just assuming a continuing rise in the marketplace, are likely to be seen years down the road as the not high-end properties. That tends to be the cycle, right? And if we do start to see even a flattening or a minor downturn, eventually those properties won't really appreciate so much, but perhaps just hold their value, resulting in those becoming, in a growing market, those properties becoming the more affordable as we see a switch in the supply and demand calculation, right? As we see that supply increase, and overtake demand, that's when we'll start to see those homes coming onto the marketplace at more aggressive prices in order to get them moved. Is that something I see happening soon? No. I think it's a dynamic that, at least in my area, we're potentially years away from. You can take a look at your area and see, and it's not something that's going to be, again, a big surprise. You're going to see construction going on. You're going to see new houses being built. You're going to see more homes going onto the marketplace. As soon as you start to see a marketplace where you have 6 or 7 months worth of inventory on hand, then you know you've moved into a marketplace where things are getting a little bit more balanced, right? Okay, so it's really more of an interesting chunk of data to just keep in the back of your head, because we are at the lowest point since almost my birth in terms of the rate of folks owning their own homes. So you can absolutely count on that coming back up, and that will absolutely have an effect on the balance between rentals and home owner occupied, which will in effect also affect rental rates. Okay, so vacancy rates are the lowest since 1993. Rent has increased at a lower rate than the median U.S. home price. So in other words, it has become far more financially reasonable to rent than to buy. Despite the fact we've seen dramatically growing rents, they haven't grown as fast as purchase price, as the price homes are selling for, which works for you as a landlord. But again, as soon as that trend changes and we start to see that inventory situation change, potentially that has an effect on your bottom line. Now, the top 5 performing metro areas we'll get into in a second. I thought it would also be interesting to talk about lowest vacancy rates. The lowest vacancy right now is in Worcester, Massachusetts at 3.05%. The highest vacancy rate is in Birmingham, Alabama at 17.67%. So even the worst case scenario at 17.67%, which is in Birmingham, Alabama, you know that you exist somewhere between those two, right? So for you to calculate what your vacancy rate is, you can go ahead and download this report. There's a PDF. There's sort of a summary that I'm also going to include as a link, but it's going to be a great way for you to ballpark what your vacancy rate is if you don't already know it. Now, for those of you who are really sort of still in the analyzing phase or thinking about the possibility of becoming a landlord, other great places to go to find out what the truth on the ground is in your immediate area is going to be your property management firms. And I'm hoping that even if you decide to manage it yourself, you're at least talking to a couple of different property management firms to find out how much they will sell their product to you. In other words, how much they will charge, what they'll do, what they would suggest you rent it for. Because even if you don't use those folks' services, they're probably going to be able to provide you with information that's going to be useful for you in the decision-making process. And if one of them impresses you enough, maybe you decide it's worth it to you to go ahead and have them manage it for you so that you're more hands-off. Okay, let's go ahead and jump in and discuss some of these numbers. The top U.S. cities and the 5 cities with the best rental return on investment by region. And this is important because this, again, is not capitalization rate. This is dollars, right? So these are tending to be the big number places. We'll get to capitalization rates here in a second, but I just wanted to forewarn you that's what they're talking about. Now, and also before we do that, let's also talk about how the rental ranking is calculated. First, they combine U.S. real estate, rental housing, and jobs data with property value appreciation forecasts. So this takes into account just about everything you'd be interested in if you were someone analyzing a market for potential investment, right? Because what do you want to know? You want to know how robust the rental market is. Is it good for jobs? Because folks with jobs, in addition to paying rent, will also someday probably become home purchasers, assuming that they've got a career that fits that bill. And also property value appreciation. That's something you want to have built in. You want to try and buy into a situation where your property is increasing in value with each year, so that when that time comes, if it comes, that you do want to liquidate the property, you've also managed to make some money on appreciation, assuming appreciation outstrips inflation. Next, nationwide network of 2,000 property managers verifies their findings. Now, this is one reason why I get a lot of reports like this. Sometimes I have people send me reports that they want me to talk about, and when I look at them, I'm like, you know what? Too small of a sample, or I'm a little bit concerned about how they got their data. This is a good one because it's based on a lot of ground truth. When you're dealing with this many property managers and getting information from them, I like that kind of data. That's good data to get your hands on. Okay, so let's start with the West. As usual, the West is kind of where a lot of this is happening in terms of just big money. Now, number 1 in the West was Seattle, Washington. Number 2, San Francisco, California. Number 3, San Jose, California. Number 4, Denver, Colorado. And number 5, Portland, Oregon. And these are all the ones with the highest return on investment. Southwest, number 1 was Austin, Texas. Number 2, Phoenix, Arizona. Number 3, Dallas, Texas. Number 4, Houston, Texas. Number 5, Oklahoma City, Oklahoma. And in the Midwest, number 1 was Columbus, Ohio. Number 2 was Grand Rapids, Michigan. Toledo, Ohio was number 3. Number 4 was Indianapolis, Indiana. And number 5 was Kansas City, Missouri. In the Southeast, number 1 was Nashville, Tennessee. Number 2 was Raleigh, North Carolina. Number 3 was Louisville, Kentucky. Number 4 was Atlanta, Georgia. Number 5, Orlando, Florida. And then in the Northeast, number 1, it always annoys me when this city's on these lists. Number 1 was Washington, D.C. Number 2 is Boston, Massachusetts. Number 3 is Worcester, Massachusetts. Number 4 is Springfield, Massachusetts. And number 5 is Baltimore, Maryland. So just by region, that's kind of how things break up. Now, the inputs that they put into this report, and I think this is also an interesting piece of data to kind of keep in the back of your head. First is vacancy rates. So lower percentages are good. Rent variance, higher percentages are good. That's the percentage change in the median rent within the metropolitan area. A high rent variance indicates rents have significantly increased. That's why higher is better. Capitalization rate. Now that compares median rental prices to median property values. Rental housing is most profitable in metropolitan areas with high cap rates, and higher is better, obviously. Property appreciation, job growth, the days on market, and that's the median number of days a property takes to sell. The stronger the housing market, the fewer days it takes homes to sell there. Future Rental Availability Index. Now, that ranks metropolitan areas by comparing their population growth to the amount of housing under construction in those cities. The higher the future housing shortage, the more rental housing owners will be able to charge for their units. So Future Rental Availability Index is a huge one. It's like a little insurance policy for you to be able to be assured that at least for some foreseeable amount of time, right? Because construction takes time, permits take time, getting things done takes time. It gives you a nice feeling of comfort at the front end to know that the projected demand for housing outstrips the building in your area in terms of knowing that you're going to have a low vacancy rate and that you're probably going to be able to continue to charge the rental rates that you're accustomed to. And then, of course, job availability, tax and insurance costs, those types of things. Now, you can go back to and look at previous reports on here and see what you think in terms of what kind of results they've gotten in the past. I wanted to go ahead and cover the top 5 of their cities and give you a little bit more information on each individual city because it's kind of interesting data to look into. We're going to cover the top 5 cities along with the numbers that got them there. Now, number 1 on the list for 2015 is San Francisco, California, and it stayed consistently strong all year, an overall ranking that slipped slowly from 1st to 4th place but still showed remarkable resilience. The best rental return on investment in the United States came in at number 1. Best rental return on investment in the West came in at number 1. Average vacancy rate, 3.6%. Property appreciation on average was 7.34% per year, which is pretty respectable. That actually slowed down from the previous year. Future Rental Availability Index, it ranked number 9 in the country. Rent variance was 7.66. 2015 job growth, 3.53%. Job availability, it ranked number 7. Capitalization rate average, 4.74%. Average days on market, 33. Tax and insurance cost index, it ranked number 10. Next on the list was San Jose, California. It ranked number 2 in both U.S. and the West for rental return on investment. The average vacancy rate is 3.68, so only 0.08 higher than San Francisco. Property appreciation was a little bit less than San Francisco at 6.32. Future Rental Availability Index, it came in at number 11. Rent variance came in at 10.57, so actually a better rent variance in San Jose than in San Francisco. 2015 job growth was 19.11%. That's more than, way more. 19.11% versus 3.53% in San Francisco. Job Availability Index, it ranks number 1 out of all the metro areas. Capitalization rate average was 4.06, so less than San Francisco. Average days on market was 34. That's 1 day more than was in San Francisco. And then the tax and insurance cost index came in at number 21. Seattle, Washington came in at number 3. Number 3 for both the West and the U.S. Average vacancy rate is 3.73. Property appreciation average is 5.56. Future Rental Availability Index was number 17 in the country. Rent variance, 18.08. So that's just crazy. Future rent availability. Wow, that's or rent variance of 18.08 is nuts. That's 8% higher than it was in San Jose. 2015 job growth, 3.35. Job Availability Index came in at number 18 in the country. Capitalization rate, 6.2%. Average days on market, 43. Louisville, Kentucky came in at number 4. It came in as number 4 in the United States, number 1 in the Southeast. Average vacancy rate, 5.9%. Property appreciation average, 2.55. Future Rental Availability Index came in as number 41 out of the metro areas. Rent variance, 5.63. So a big jump down in terms of rent variance compared to places like Seattle and San Jose. 2015 job growth was 3.05%. Job Availability Index ranked number 29. Capitalization rate, though, is at 7.75. Average days on market was 66 days. And the tax and insurance cost index ranked number 10. The number 5 on the list, and this is far down as we're going to go. You can see the rest of them if you like. You can check out the PDF for this. There'll be a link to it at my site in the show notes. Best rental return on investment in the U.S. was ranking number 5. In the West, number 4. Average vacancy rate, 3.43. Property appreciation average, 3.69. Future rental availability index 18, rent variance 3.08, job availability index ranked number 61, capitalization rate average at 4.63, average days on market 48, tax and insurance cost index ranked 10th in the country. All right, so let's talk about vacancy rates here for a second. The best 5 in terms of the lowest vacancy rates. In other words, you put that thing on the market, that thing rents, and it rents fast. Worcester, Mass. was 3.05%. Los Angeles, California, 3.28%. Providence, Rhode Island, 3.3%. Boston, Massachusetts, 3.38%. Portland, Oregon, 3.43%. In terms of rent variance, let's see. Seattle, Washington was number 1 with 18.08%. Oxnard, California, 10.89%. Baton Rouge, Louisiana, 10.57%. Syracuse, New York, 9.5%. Fresno, California, 9.33%. That blows me away for Fresno because Fresno actually also has a relatively low barrier to entry in terms of home costs. So, I mean, that's actually kind of nice. Capitalization rate. This is one of my favorites. Best 5. Now, capitalization rate, and their capitalization rate, I get the feeling is being calculated a little bit differently from the way that I classically define it. They put it out as capitalization rate compares median rental prices to median property values. It's gathered from HUD data, annualized, and divided by the median list price on Realtor.com. Rental housing is most profitable in metropolitan areas with high cap rates. So, for me, a capitalization rate is what you make over and above everything else. You put a cap rate on how much you want to make, and then that's kind of what it is. Now, it sounds like they're deriving a similar number to what I would define it as from their calculations. But let's go ahead and share what they consider to be the top 5 areas by capitalization rate. Number 1, Dayton, Ohio. What's interesting is how Ohio dominates this list, interestingly enough. Dayton, Ohio was at 13.15. Akron, Ohio was 10.4. Toledo, Ohio was 9.9. Detroit, Michigan was 9.84. And Rochester, New York was 9.71. Now, what's interesting about this list is at the other end, the bad end, the lowest return on investments, right? Number 1 worst, Bridgeport, Connecticut, 3.23. Los Angeles, California, 3.72. Remember, working from the bottom of the list up on this one. Excuse me. San Jose, which, remember, is also the highest return on investment, right, because they're strictly dealing in dollars. San Jose, California, 4.06. Oxnard, California, 4.11. And Denver, Colorado, 4.15. Now, remember, also, there's clearly a how they're calculating this difference, because remember a similar report that we talked about that focused on capitalization rate. When we were talking about this about 4 months ago, Memphis, Tennessee came in at the top of that list. And Memphis didn't even make it on here this time. So something you'll want to keep in mind when you're calculating what your capitalization rate is for your area, don't assume anything based on what you read. Always verify, always double check, particularly these numbers that can mean a huge difference to you in terms of what you're going to make off of your properties in a different investment market. In terms of property appreciation, top 5 were San Francisco at 7.3, Miami, Florida at 6.99, Denver, Colorado at 6.9, Las Vegas, Nevada at 6.76, and San Jose, California at 6.32. And frankly, the two that jump out at me on that list are Miami, Florida, and Las Vegas, Nevada, where you can still acquire some properties for a relatively reasonable amount of money. Plus, Miami is still going through some of their foreclosure problems in terms of them having been a judicial state where you have to go through the courts in order for foreclosures to happen. And they've just finally now started working through the last chunk of those. Let's see here. A future rental availability index. Now, I like this one. This is another number that I might want to make as part of my normal comparison of different markets, simply because it's taking census data and it's projecting forward by comparing the amount of construction that's going to be happening versus projected population growth. And that's huge, because that's a big leading indicator. So if you see that there is an awful lot of housing going on, but not as much expected migration, then that tends to indicate you're going to have more inventory than you have buyers, at least over in the long term. So perhaps keeping this in mind is something that's going to help you defend yourself against future depreciation in your property. Now, the absolute best on this list were Austin, Texas at number 1 with negative 1.47%. San Antonio, Texas, negative 1.31%. Houston, Texas, negative 1.27%. Denver, Colorado, negative 1.12%. And Orlando, Florida, negative 1.09%. Now, there's other data here that we're not going to cover in today's show. I'd suggest that you go and take a look at it. Every element that we've talked about is covered when we summarize them at the beginning of this. So if you're interested in those other ones, absolutely check those out. But what's really interesting here is how frequently Denver has shown up on our list. Now, I'd love to get some on-the-ground truth from folks in Denver. The last time I talked to someone from Denver, the rental market was super easy, lots of incentives to get you through the door, but purchasing was still ridiculously competitive and one of those deals where you're just making offer after offer after offer, and it's multiple offers every time, and you keep getting nudged out of the marketplace. That's an interesting thing to see, particularly since the projection is a continuing move of increased property values, of increasing return on investment, of higher capitalization rate, of continuing to not build enough homes to satisfy demand. That's what Denver is. Denver's falling in on all of these lists. So that absolutely should be something that would draw your eye if you're someone looking for a market to invest in. Or if you currently live in Denver, you may find yourself in a position where it makes sense for you to look into your options in terms of different investments that could work for you, because all of these numbers are pointing to really good things, particularly in Denver. Now, the future rental availability index also indicates to me that a lot of the assumptions we made on this show before relating to places like Austin and other Texas communities are still ringing true. They're still seeing an awful lot of demand. Austin is in a number one position to see continued increase in property values as they're just not building enough homes to satisfy demand, as more people migrate to Austin. I just had a person call me about listing their house who was going to be moving to Austin. So, more and more ground truth of what I'm seeing, more and more of what we're seeing in terms of just general data for Austin really points to a continuing demand in a marketplace where they're just not building enough to satisfy it. All right. Well, I hope that was some useful data, folks. There's a lot of data points out there to kind of take a look at, see what matters to you. Once you've got a kind of an idea, feel for what these are saying about the metro areas you're most interested in, start gathering a little bit of local data. See how much your local information jives with what you're getting from this, because it may tune you into something, but it never is a substitute for you actually drilling down yourself and getting that real hands-on analysis of the data for your area. But these are all good data points, all good places to start your research. So feel free to jump in and make that happen. All right. As always, thank you very much for making the show a daily part of your weekly routine. If you'd like to get in contact with me, the best way to do that is to head on over to www.therebelbroker.com. You can click on the Contact the Rebel Broker link in the upper right-hand corner. Send me any messages, ideas, suggestions, observations, or questions that you might have, and I'd be happy to answer them for you. And, of course, please, if you can take a minute out of your day, head on over to www.therebelbroker.com. There's a button on the very top of the page that will link you to a survey that will absolutely help me and my goal of growing the show. So if you could take a minute out of your day to take care of that, I would be forever in your debt. As always, thanks for listening, folks, and I'll talk to you all next time.